Hello, I'm John A.G., and there's a specific kind of unease that shows up right before people realize they were watching the wrong thing the entire time. It doesn't feel like fear. It feels like irritation. The numbers don't make sense, but you assume they will later. The explanations sound thin, but you accept them because they're familiar. You tell yourself the market is just doing what markets always do. And in that quiet self-assurance, something far more important settles into place without resistance. At the beginning of this year, silver offered everyone a distraction that felt convincing. Prices collapsed. Charts broke. Confidence evaporated in public. Commentators mocked what they could finally dismiss again. It looked like resolution, like the end of a story people were tired of hearing. When price does that, it gives permission to stop thinking. It creates the illusion that whatever mattered has already been decided. That illusion is useful because it keeps attention locked on motion instead of mechanism. There's a deeply ingrained belief that if something truly changes, price will be the first to tell you. That belief is comforting because it means awareness is passive. You don't have to understand policy, incentives, or structure. You just have to watch the screen. But markets don't work that way when power and supply intersect. Price reflects pressure, not control. And control almost never announces itself through volatility. It arrives quietly, through paperwork, thresholds, and eligibility rules that don't trend on charts. On January 1st, 2026, one of those rules changed, not loudly, not ceremonially. It simply went into effect. China implemented a new export control system for refined silver. Under the previous framework, a broad range of Chinese refiners could export silver freely. Small operators, mid-sized refiners, flexible suppliers who responded quickly to shifts in global demand. That ecosystem made Chinese silver feel abundant, responsive, and interchangeable. It created the assumption that supply would always adjust to price because it had before. The new system ended that assumption. Export permits became mandatory, but eligibility itself was restricted. Only refiners producing more than 80 tons of silver per year could even apply. That single number quietly erased most participants from the global market overnight. Approval was granted to 44 companies, not 44 product lines, 44 exporters, every one of them large, state-affiliated, and structurally aligned with Beijing's priorities rather than global price signals. This matters because when access narrows to entities that answer upward instead of outward, supply stops being elastic. It becomes conditional. China produces roughly 21,000 tons of refined silver annually. Historically, about 4,000 tons flowed to Western markets. Analysts now expect exports to fall by 30 to 50% under the new system. That's a gap of roughly 1,200 to 2,000 tons per year. Not destroyed, not consumed, simply redirected. The official language frames this as industrial security and resource security. That phrasing isn't decorative. It signals intent. Silver is no longer treated as a neutral commodity. It's treated as a strategic input. Solar manufacturing, batteries, electronics, semiconductors, military applications, these aren't cyclical fads. They're long-term national priorities. When a state recognizes dependency at that scale, it doesn't leave allocation to market convenience. While this structural change was taking effect, attention was pulled elsewhere. China's only exchange-traded silver investment product became the visible story. Liquidity had been flooding the Chinese financial system while the real economy struggled to absorb it. When traditional investment channels stop working, capital doesn't disappear. It searches. Commodities became that outlet. The silver fund swelled rapidly as speculative demand piled in. The secondary market price detached from net asset value. At its peak, investors were paying more than double the actual underlying value just to gain exposure. That distortion wasn't sustainable. When global silver prices reversed, the structure of the Chinese market amplified the move. Daily price limits slowed adjustment on the way up and locked it on the way down. The fund hit maximum allowed losses session after session. In a matter of days, it lost more than 40% of its value. Even after that collapse, it continued to trade at a substantial premium to net asset value, a sign that price discovery itself was impaired. It's tempting to read that episode as a referendum on silver, to conclude that enthusiasm ran ahead of fundamentals and got punished. That interpretation is emotionally satisfying because it offers closure. Excess has been cleansed. The market has spoken. But that story confuses mechanism with outcome. What actually happened was a collision between excess liquidity and constrained structure. Speculative demand met artificial limits. Price responded violently. Physical reality didn't change at all. This is where the false comfort trap forms. The visible damage creates the belief that risk has been resolved. That belief allows people to stop examining what changed underneath. The fund can reprice, it can halt, reopen, compress premiums, and eventually normalize. Paper structures are designed to heal. Supply structures are not. Export permits don't revert when sentiment improves. Thresholds don't disappear because charts look constructive again. History shows that strategic control is established before scarcity becomes obvious, not after. Rare earths followed this path. Control consolidated quietly. Markets ignored it until access tightened enough to matter. By then, adaptation was expensive and slow. The same pattern repeats because the mechanism works. Markets are conditioned to respond to price, not to policy details that feel boring until they're binding. Second-order effects don't arrive as shocks. They arrive as friction. Industrial buyers don't panic immediately. They draw down inventories. They adjust contracts. They search for alternatives. Small buyers feel stress first. Larger ones absorb it longer. Premiums rise quietly in places that don't make headlines. None of this requires higher prices right away. It requires awareness that future access is no longer guaranteed. The uncomfortable reality is that liquidation and structural tightening can happen at the same time. The selling pressure that drove prices down was real, but temporary. The export restrictions are durable. When forced selling exhausts itself, the market doesn't reset to the old assumptions. It resets to the new constraints that were put in place while attention was elsewhere. This is why price crashes are often misread. They feel definitive. They feel like answers. In reality, they often serve as cover. They absorb attention while control shifts quietly in the background. When confidence finally reconnects with availability, the adjustment doesn't look like a rebound. It looks like confusion. Prices don't behave the way people expect because the rules they're using are outdated. None of this requires belief. It requires noticing where flexibility disappeared. When thousands of refiners are reduced to 44 exporters, optionality shrinks. When export access depends on state approval, price stops being the deciding factor. When that happens, markets continue to trade, but outcomes are decided elsewhere. The real discomfort isn't that silver fell. It's that the fall convinced people the story was over, when in reality the conditions that shaped the next decade were just quietly locked into place. Once that illusion of resolution settles in, behavior begins to shift in ways that aren't obvious from the outside. Volatility fades, emotions cool, and people assume the worst has passed simply because the noise has diminished. This is usually the most misleading phase. Markets don't reset when fear subsides. They reset when assumptions fail quietly and new constraints become normalized. By the time that normalization feels obvious, the adjustment has already taken place beneath the surface. In China, the dynamics that fed the silver fund distortion never actually went away. Liquidity didn't leave the system. It remained abundant, searching for relevance. The real economy continued to struggle to absorb capital productively. Credit growth lagged money creation. Households stayed cautious. Fixed investment slowed. Under those conditions, speculation wasn't an anomaly. It was an outlet. Silver became a pressure valve, not because of its fundamentals, but because it was accessible, visible, and emotionally resonant. The fund's collapse didn't eliminate that excess liquidity. It only forced it to retreat temporarily. What changed was not the presence of capital, but the tolerance for obvious distortions. When prices fell violently and limits locked traders in place, confidence in that specific vehicle broke. That doesn't mean speculative behavior disappeared. It means it learned where the constraints were. Markets always do. They adapt faster than commentary, faster than regulation, and often faster than policymakers expect. What policymakers did anticipate, however, was the strategic value of controlling physical flow while speculation absorbed attention. From a state perspective, these are not contradictory forces. They're complementary. Financial volatility distracts. Administrative control endures. When export eligibility narrows, domestic planners gain predictability. They know where refined silver will be available. They know which industries will be prioritized. They know which firms will have guaranteed access regardless of global price swings. That certainty has value far beyond short-term revenue from exports. For Western industrial buyers, the experience is very different. Their systems are built on assumptions of openness and redundancy. Supply chains are optimized for efficiency, not for resilience against policy-driven choke points. When Chinese silver was widely available, that optimization made sense. It reduced costs and smoothed planning, but optimization without control creates fragility. The moment access becomes conditional, efficiency turns into exposure. At first, this exposure isn't dramatic. Orders still arrive, contracts still function. The difference is subtle. Delivery windows stretch. Quantities are negotiated more tightly. Priority customers are favored quietly. Smaller buyers discover that spot availability isn't as flexible as it used to be. None of this triggers headlines. It triggers internal adjustments. Procurement teams revise assumptions. Inventory targets inch upward. Hedging strategies change tone, shifting from price protection toward access protection. This is where the disconnect between paper and physical begins to matter more. Paper markets respond to sentiment, leverage, and positioning. Physical markets respond to logistics, permits, and allocation. When those two drift apart, prices can remain depressed even as availability tightens. That feels paradoxical to anyone trained to treat price as the ultimate signal, but it happens regularly in markets transitioning from abundance to control. The signal shifts from screens to contracts, from charts to conversations that never leave conference rooms. History suggests this phase lasts longer than people expect. Control doesn't immediately produce visible scarcity. It produces asymmetry. Some participants adapt early, others don't notice until their margins compress or their suppliers renegotiate terms. Governments respond last, often framing their actions as responses to market conditions rather than acknowledgments of earlier policy shifts elsewhere. By then, leverage has already migrated. The key mistake during this phase is assuming that weakness equals irrelevance. A falling or stagnant price is interpreted as proof that concerns were overstated. That interpretation reinforces complacency. It allows systems to drift further into dependency without resistance. When adjustment finally becomes unavoidable, it arrives as a surprise, even though the conditions that caused it were in place for years. Second-order effects accumulate quietly. Recycling becomes more important, but scaling it takes time. New mining projects are discussed, but permitting and capital constraints slow progress. Substitution is explored, but technical limitations cap its effectiveness. Each of these responses helps at the margin, but none restore the flexibility that was lost when export access consolidated. They manage symptoms, they don't reverse structure. What makes this uncomfortable is that there's no single moment of recognition. There's no bell that rings to signal that the old assumptions are invalid. Instead, there's a gradual realization that planning requires more contingency, more buffer, more negotiation. That realization spreads unevenly. Those closest to physical flow feel it first. Those farthest from it dismiss it longest. This gap creates confusion in public discourse, where price-driven narratives dominate while access-driven realities evolve quietly. The earlier fund collapse reinforced that confusion. It offered a simple explanation for complexity. Excess speculation led to excess losses. End of story. But that explanation ignores timing. The export restrictions didn't cause the fund's collapse, and the fund's collapse didn't negate the export restrictions. They occurred simultaneously, interacting in a way that masked the more durable change. Liquidity-driven volatility created the cover under which structural control took hold with minimal scrutiny. This is why confidence becomes such a fragile asset in this phase. Confidence isn't lost because prices fall. It's lost because expectations fail repeatedly. When buyers assume availability and encounter friction, trust erodes. That erosion doesn't show up as panic. It shows up as caution. Caution spreads. Orders become conservative. Long-term commitments are delayed. All of this dampens visible demand, reinforcing the illusion that nothing is wrong, even as underlying dependency grows more pronounced. At this stage, the market isn't broken. It's bifurcated. Paper markets continue to trade narratives. Physical markets quietly reprice access through non-obvious channels. Those two realities coexist until something forces reconciliation. That forcing mechanism is rarely a single event. It's often a sequence of minor disruptions that collectively change behavior. By the time reconciliation occurs, it feels sudden, even though it was years in the making. The hardest part to accept is that none of this guarantees higher prices in the short term. Structural tightening doesn't obey emotional timelines. It compounds slowly, then asserts itself when adaptation windows close. Those who expect immediate validation through price often conclude they were wrong and disengage. Those who focus on mechanisms stay engaged, not because they expect certainty, but because they recognize asymmetry between what's visible and what's changing. This is the mental shift that separates reaction from positioning. Reaction waits for confirmation. Positioning acknowledges uncertainty and adjusts quietly. It doesn't require conviction about outcomes. It requires recognition that the rules governing access have changed, even if the market hasn't fully priced that change yet. The deeper question this raises isn't about silver alone. It's about how many other markets are being evaluated through outdated lenses, because control hasn't yet translated into visible scarcity. When policy, not price, determines flow, traditional signals lag. And when signals lag, those relying on them feel blindsided later, insisting the shift came out of nowhere. The discomfort many people feel at this stage isn't confusion. It's the tension between old models and new realities. Price-based intuition says the story is over. Structural observation says it's just getting started. Reconciling those two takes time, and most participants don't do it consciously. They do it through experience, often after options have narrowed. The question that quietly forms here isn't whether silver will rally or fall next. It's whether markets built on assumed flexibility can adapt fast enough when flexibility is replaced by permission. As permission replaces flexibility, the market doesn't seize up, it recalibrates. That recalibration is subtle enough that most people miss it entirely. Supply still exists, metal is still produced, transactions still occur. What changes is who gets certainty and who absorbs uncertainty. That distinction doesn't show up in spot prices. It shows up in planning horizons. Some participants can commit months or years ahead with confidence. Others operate hand to mouth, exposed to delays and renegotiation. Over time, that imbalance reshapes entire industries without ever triggering a dramatic shortage headline. From the outside, it looks like nothing is wrong. Solar projects continue. Electronics manufacturing expands. Defense procurement moves forward. Silver appears available, just a bit more complicated to source. That complexity is the signal. Complexity is the cost of control. When supply chains grow more complex without becoming more efficient, it usually means decision-making has shifted upstream. Price is no longer the sole arbiter. Approval, priority, and alignment matter just as much, if not more. This is where many observers misinterpret resilience. They see adaptation and assume the system absorbed the shock. In reality, adaptation often hides vulnerability. Firms adjust because they must, not because conditions are benign. Inventory buffers grow quietly, contracts shorten, supplier relationships concentrate. These adjustments reduce visible stress while increasing dependency on fewer channels. The system looks stable right up until it isn't, because stability has been purchased with optionality. China's position in this environment is straightforward. By narrowing export access, it gains leverage without confrontation. Domestic industries receive preferential treatment implicitly. Strategic reserves can accumulate quietly during periods of price weakness. International negotiations carry an unspoken backdrop of material access. None of this requires explicit threats. Control itself does the work. When a country can decide whether a shipment leaves port, influence is exercised silently. For Western economies, the challenge isn't immediate scarcity, it's coordination. Responses are fragmented across firms, sectors, and governments. Some companies move early to secure alternative supply. Others wait for clarity that never fully arrives. Policymakers debate incentives and subsidies while assuming markets will self-correct. But markets can't self-correct when inputs are governed by policy elsewhere. They can only reallocate stress. That reallocation usually hits the weakest links first, then spreads. The earlier price collapse plays a critical psychological role here. It reinforces the belief that silver's relevance was overstated. That belief delays adaptation. When prices are low or volatile, urgency feels misplaced. Why worry about access to something that appears unwanted? This is how structural risk hides in plain sight. Price weakness becomes camouflage. By the time demand asserts itself again, the supply side is already constrained by rules that don't respond to renewed interest. Paper markets, meanwhile, continue to do what they're designed to do. They provide liquidity, hedging, and narrative. They smooth some risks while amplifying others, but they don't resolve access. When physical flow is conditional, financial abstraction can only postpone reconciliation. Eventually, claims must meet reality. When that meeting happens, it rarely looks like a clean repricing. It looks like dislocation, regional divergence, and frustration among participants who assumed fungibility where none existed anymore. The most important shift during this phase is cognitive rather than quantitative. Participants stop asking what something costs and start asking whether it's dependable. Dependability becomes the scarce asset. Those who can guarantee it gain influence disproportionate to volume. Those who can't become price takers regardless of demand. This inversion catches many off guard because it contradicts decades of globalization logic, where scale and efficiency dominated outcomes. There's no single trigger that marks this transition. It's experienced as a series of small surprises. A supplier hesitates. A contract changes language. A delivery window slips without explanation. Each incident is manageable. Collectively, they change behavior. Firms become conservative. Investment decisions slow. Planning incorporates contingencies that weren't needed before. These adjustments dampen visible demand, reinforcing the impression that fundamentals are weak, even as underlying dependency grows. What makes this particularly unsettling is that it unfolds without consensus. There's no moment when everyone agrees the rules have changed. Some adapt early and quietly. Others deny the shift until it affects them directly. This staggered awareness creates uneven outcomes that feel unfair in hindsight. Those who waited for confirmation discover that confirmation arrives only after options narrow. By then, leverage has already moved. The lesson here isn't about silver alone. It's about how modern markets behave when strategic considerations override commercial ones. Materials once treated as interchangeable become differentiated by access. Prices lose their signaling power temporarily because they reflect liquidation and sentiment rather than control. Observers who rely exclusively on price feel disoriented. Observers who track structure feel uneasy but prepared. Neither group has certainty. Only one group recognizes that certainty itself has become scarce. As this reality settles in, the narrative around recent events will likely be rewritten. The price crash will be framed as an overreaction. The fund collapse will be cited as a speculative episode. The export restrictions will be mentioned in passing, if at all. But outcomes will be shaped by that last detail, not the first two. History tends to remember mechanisms, not distractions, even if it takes years for that memory to crystallize. The most uncomfortable implication is that many markets may already be further along this path than people realize. Silver is simply visible because it sits at the intersection of technology, energy, and geopolitics. Other materials follow similar dynamics quietly. The same administrative tools, thresholds, and approvals appear elsewhere, often justified by stability and security. Each instance narrows flexibility a little more, while prices continue to fluctuate loudly enough to hold attention. So the final uncertainty isn't about timing or direction, it's about awareness. When access, not price, becomes the binding constraint, traditional signals fail first. Those watching screens feel informed, while those watching policy feel uneasy. Over time, that imbalance resolves, but not gently. It resolves through recognition that markets don't only clear through price, they also clear through permission, and that leaves a question worth sitting with. In a world where control is increasingly exercised quietly and prices remain volatile enough to distract, how many assumptions still feel solid simply because they haven't been tested yet?